What is going on, guys? Today in this video we are going to talk about all the news today, the news about interest rates, and that's what's going on in the market. And we're going to talk about how the market has reacted today. We're going to talk about everything that was kind of released during the Fed's meeting. We're going to go through an article by CNBC and basically walk through everything that was talked about, everything, get into the details, get into my opinions on it, and then we're going to end with maybe why the market went up, because what we'll see is obviously not everything in the Fed meeting was bad, but it also wasn't great. So it's interesting that the market had such a good day today. So that's what we're going to get into in this video. If you like the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So let's take a look at the S&P 500. So the S&P 500, we're looking at SPY, and what we have is almost a 1.5% increase in SPY, and we're sitting at 1.43. And throughout the day, you can see there's a lot of volatility in here. This is when Jerome Powell ended up talking, and things kind of got volatile in there. And overall, you know, the market originally kind of sunk down as some of the bad news, bad kind of talking points that he hit on, and then overall it actually bounced back and reacted in a very positive way. If we look at the last 5 days, we know the CPI data, consumer price index, basically where inflation's sitting at, came out late last week, and that drove the market super low, you know, throughout the day, Thursday into Friday, and then opening here today on Monday, actually drove the market super low as people kind of started anticipating maybe even a 1% increase in interest rates from Jerome Powell today. And what we'll see later is that didn't exactly play out that way, and that's potentially why the market kind of reacted to the upside. So we see a little upside movement here on Wednesday. Some of these kind of numbers and discussion points are were released by the Fed. So here's the article that we're going to look at today by CNBC, and the headline here is Fed hikes its benchmark interest rate by 0.75%. Or percentage points, the biggest increase since 1994. So that is huge. And we have some highlighted kind of talking points here throughout the article. So these are kind of the key points. Again, that's the most aggressive hike since 1994. So 0.75 percentage points. That's huge in terms of what we've seen. And obviously it's been almost, 20 years since we've seen something similar. So that's kind of crazy. And then here, according to the dot plot of individual members' expectations, the Fed's benchmark rate will end the year at 3.4%, a revision of 1.5% percentage points upward since its estimate in March. So that's also huge. Basically what that is saying is a combination of looking at all the members of the Fed. Basically they're predicting that their rate will end up at 3.4%. Right now it's at like 1.5 to 1.75%, which is again a huge increase. So they're saying basically they're going to double the rate in the back half of this year. And then the other thing is that's a huge revision up from their previous expectation. So that's a 1.5. So they were trying to get it up to like 2%, but now they're predicting all the way up to 3.4%. So that's very aggressive and kind of a negative note there. And then the last one we have here is officials are also significantly cut their outlook for 2022 economic growth, basically anticipating that the GDP would only gain 1.7% instead of the 2.8% that was predicted back in March. So those last 2 points are huge, basically downward points. And even the first one, obviously 3/4 of a percentage point, is being the highest hike since 1994. Here we have a couple interesting talking points. So this is Jerome Powell talking, and he said, clearly today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. He also added, though, that he expects the July meeting to have an increase of 50 to 75 basis points. So he says in one basically line, says that 75 basis points is unusual, but in the very next line he says in July we could possibly see 75 basis points. And what he's kind of getting at, you know, that's kind of saying two things, but this next statement down here kind of shows why his train of thought. So he says, we want to see progress. Inflation can't go down until it flattens out, Powell said. If we don't see progress, then that could cause us to react. soon enough we will be seeing some progress. So basically what he's saying, there's kind of two ways to look at this. You could look at it from the negative standpoint, and then you could also look at it from the positive standpoint, depending on what your frame of mind is. So he says we can't see inflation go down until it flattens. So we've kind of started to see that. We've seen inflation hover around that 8.5% for the last couple of months. So it's almost like it's flattened, but I don't know if Powell's really saying that. Again, and this is where I'm getting into the negative aspect. So if you have a more pessimistic kind of outlook at this, then you could look at this statement and say it hasn't flattened out yet. We haven't seen it consistently flatten out, because I would argue, you could make the argument that 3 months is not really a flat line. You need a few more data points to really get a better understanding of where inflation is actually sitting at. So if you look at it from that standpoint, you could also see Powell basically stating that, hey, we need to be more aggressive here and take more action to get this to flatten out, and then ultimately to get inflation coming down. So that's kind of two ways of looking at it. So if we see the CPI data in July kind of come out for June, basically saying that if inflation kind of flattens out or goes up, then we could definitely see Powell increase interest rates by another 75 basis points. And I think that's kind of why he throws that in there, because he's trying to make the market not be surprised if that's the case. He's saying in one tone, hey, it's unusual, but we're in unusual times, so we may need to increase by 75 basis points. So that's kind of what I'm looking at here. Overall, there's just a couple different ways that you can react to this, and it seems like the market kind of reacted to it in actually a positive way, kind of looking at this, that they're taking action against inflation and they're going to do what they need to do to slow it down. Here we have another statement. This one wasn't directly made by Jerome Powell, but it was made by the overall committee. So overall economic activity appears to have picked up after edging down in the first quarter, the statement said. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. So overall, this is kind of a positive thing. I mean, right, they're talking about job gains, which is huge, especially when you're looking at a potential recession. If job gains and basically the job market starts falling off, that's when you should really get worried about a recession coming, because basically at that point nobody has any money, right? If you don't have a job, you don't have any money, and you can't purchase any goods. So just by snowball effect, everything kind of starts going downhill from there. So overall, a positive thing there. Inflation, they're basically just stating in this that their biggest problem right now is just inflation. Nothing else is wrong with the economy. It's just the fact that, hey, we have this high inflation number and it could hurt us in the long run if we let it keep getting away from us, and we're going to do what it takes basically to get this number down. So it's interesting here also, they give economic projections for inflation. So they're kind of expecting it by 2023, they just say in 2023, to move down to 2.6 to 2.7%. So that's a lot more in par with what we've seen. What we'll see here next is the Fed actually likes to target a 2% inflation rate. So a little bit higher than that. So it sounds like, over 2023, they might try and either barely edge up interest rates to kind of get that back down to 2%, or they might leave it and just kind of let things settle and see if it kind of settles down into that 2% inflation number that they're trying to target. So here's what I was just talking about there. So they're strongly committed to that 2% inflation goal. But what's very interesting is this statement here. So basically the Fed expects inflation to return to its 2% objective and the labor rate market to remain strong. That was their statement originally, basically last Fed meeting. Their new statement has changed to basically only saying that it is committed to this goal. So it is committed to this 2% inflation objective is basically what they're saying. So they've kind of cut out the part of the labor market remaining strong, which should be concerning for a lot of investors, because if they're not concerned about the labor market and they're only concerned about driving inflation down, then they could run the risk of, overcorrecting and potentially basically creating an economy where there's a large loss in jobs and thus driving us into a recession. So that is something to be careful of. I kind of wish they had left that in, because I think that's a good goal to keep intact, is making sure that you have the labor market be strong. It's almost more important than inflation, because wages can always increase, and it's not necessarily easy on consumers to have that going on, but it's always going to be better for more Americans and people to have jobs and basically have an income coming in. So that's kind of a little bit concerning, but again, the market kind of just breezed over that statement. Last little point up here we have is, again, about jobs. So what we have here is they're basically saying that the job market overall has been very strong, even though May's job gain was the lowest since April of 2021. So in May, they reported increase in jobs of 390,000, which was kind of in the peak of a lot of things going on. There's been a few job freezes since, so this number, things overall could kind of regress. But it's very interesting here, this next statement. So the committee projections released Wednesday see the unemployment rate currently at 3.6%, moving up to 4.1% by 2024. So they're kind of projecting over the next year and a half that jobs will actually kind of regress. So there will be more people without a job by 2024. So this is very interesting, because it's almost like a couple things are happening. Either they're saying that they're basically fine with losing these jobs and sacrificing the increase in interest rates for less people to have jobs, or maybe they're using this as a benchmark number and they're saying, back when we were at around 2 or 3% interest rates, this is where we were consistently seeing the job market hit of 4.1%, because we have had a very, very, very strong job market over the last year, 2 years. And a lot of that has came from having low interest rates, having a lot of money in the economy, places and people basically hiring for any position that they needed filled. And really, as interest rates rise, you could see a lot of those projects that were more like to haves kind of basically disappearing, and people being a little bit more focused on how they spend their money, because the money that they're getting is a little bit more expensive. So the final point that I really wanted to get it into to wrap up this video, and I couldn't find the exact article that I read it in, but basically on Monday, on late Monday, expectations of 75 basis points at the June meeting jumped to 96% from 30% earlier in the day. So basically, the reason the market reacted the way that it did, even though there's a lot of negativity still in from the Fed meeting, it's basically a tale of, hey, we think we overcorrected in a lot of these downward moves, because a lot of the market, if 96% of people were expecting a 75% basis points, there had to be a large percentage of those people who expected even a 1% move. So when you think about that, right, instead of having a 1% move, you only had a 75% basis move. That's huge. If the market, I think if the Fed had increased rates by 1%, by 1 basis point today, or 100 basis points today, I think the market probably would have gone down. And I think we would have seen a vastly different reaction than what we saw. But because the market kind of already priced in a really bad news and a really bad move, just some of these good news things kind of popped out. And that's very interesting to see. Normally you start seeing that when a market is about to start turning to the upside. But again, I don't fully think that that's going to happen. I don't think we're going to see the market fully turn until we start getting inflation numbers that are actually coming down. I think that's going to be huge, and that's going to be what the telling point is. So hopefully we see that over the next coming months. But yeah, you never know. The numbers have just been all over the place and just crazy lately. So I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, have a wonderful rest of your day.